that we're seeing in the economy is that juxtaposition between really slowing growth and lingering inflation. We're looking at a 40-something plus trillion dollars worth of debt by the time this administration is over in 4 years. And so we have to really recognize that the general debt to GDP of the world of 3 to 1, meaning that for every $3 of money that's borrowed, only $1 of actual growth is created. We're still in a situation where we're struggling against debt to grow. That's the baseline. That's not good, but there are areas from an investment standpoint, also from a focus standpoint, where this administration and the world and investors can actually focus on as we continue to grapple with what will be these lingering items. And there was discussion at the end of last year about whether a debt cap would be abandoned completely or not. It almost doesn't matter, because the reality is the United States doesn't have enough money to meet its budget. That's why we have the growing deficit. That's why we have this growing debt. And then to the extent that any policy that reduces revenue, even briefly, whether that's from cutting corporate taxes or whether that's because tariffs, which should bring in revenue, actually have retaliatory effects and reduce our trade with other countries. But these are things that we have in front of us that we're going to see ramifications for. That all means that debt increases. And even if we cut items of the budget, and I'm already booking up meetings with congresspeople on both sides of the aisle into this coming year about policies that can help initiatives that have bipartisan agreement under this administration for the United States as a whole, but also recognize the pile of debt and recognize the need to also at least notice inflation and contain that growing into these areas. So these are all things that are in play. It really depends on the product and the supply chain. There's no such thing as every tariff is bad or every tariff is good. In general, the cost of tariffs are borne by end consumers. We know this. That's because companies, multinational corporations will want to hedge themselves. They have to grow themselves. They have to face their shareholders, etc. So there will always be sort of downstream effect of tariffs. Now, one of the things that we've seen, which is interesting, is China, for example, since the last set of tariffs, and really since 2018, and it should be noted also that the Trump 1.0 did levy additional tariffs in a number of different areas, certainly on some of our allies, on China and so forth, but so did the Biden administration in terms of China. They actually increased a number of tariffs, including in permanent magnets, including in EVs, including in areas that this administration is also taking a look at. So we've had this increase of tariffs along the way, and while that has happened, we have seen prices rise. We have also seen inflation linger, and to an extent it rose and now it's kind of come down, but it still exists. We've seen China re-emphasize its base of trading partners in different ways. So instead of continuing to export as much to the United States, which would mean paying the tariffs and coming into our till if it were to have continued to do that, which is potentially net positive, but it's not. It's just growing its trading base around the world, as a smart economist or a country that's depending on, looking at its economy slowing is want to do, and not paying those extra things. So what we've seen, for example, with EVs, China had a 25% increase in EV exports last year, which also means an increase in its need for copper and wiring and battery technology and processing and so forth. But none of that was into the United States. That all happened with other allied countries. So what we see is a realignment that occurs because of tariffs. In the process, people will pay more when the supply chain ends with them. So companies from Walmart to Costco, who had really struggling last year, we're actually seeing a lot of closures and even bankruptcies in some of that chain, will want to push that cost onto consumers, and they will. But as a result, they actually could see lowered consumption and lower purchasing. This is an influx relationship that we're seeing. I think that, and especially in the wake of in Trump 1.0, we saw a sort of new NAFTA come out. And the idea of that was to have better trade relationships. And so the potential additional tariffs on Mexico and on Canada run sort of counter to that. I am surprised by if we do wind up slapping all of those tariffs on. I mean, some of them could be between 20, 40% increases on certain products. That really does dent the relationship, and maybe that will change, post-Trudeau. But the point is that also it hurts our own economy because we process outside. We get, for example, a lot of our silver from Mexico. We get a lot of other supplies from natural resources from Canada. that we process outside of the United States, and then we reassess products here. And so all of that, when you look at it from an economic standpoint, if that is your goal, could have real ramifications on the United States. And especially if we're looking at a global transformation of trading partners, or how the makeup of imports and exports is going. We may wind up purchasing something more expensively because it goes from Canada to some other country and back to us than if we just had less of a tariff on Canada and there's more of an impetus to export to us. I think we're not going to see the height of those tariffs that was discussed during the election. I think they'll be dialed back. They were in the beginning of the first set of tariffs on Mexico and Canada. I expect that to happen again because it helps us from a standpoint, both economically and from a national security perspective, to have tighter economic ties, particularly up and down the supply chain with our closest geographic and historic allies. We saw a teeny little of a dip in one inflation number in December, but the rest sort of were popping up into the end of the year. And that was one of the reasons why Powell sort of put the brakes on and the market freaked out for a minute. It was an overreaction and it popped back up after he said that we're only going to have 50 basis points of easing in 2025 versus the sort of prior dot plot earlier in 2024, which had said it'd be potentially up to 100 basis points. What he did was he just went back into his language repertoire of, we still got persistent inflation, it's still lingering, we're going to be data dependent, et cetera, et cetera. I think that we're not going to see a rate cut in January because of that. However, I do think we're going to see more than 50 basis points of rate cuts over the year for another reason, which is that our economy is actually slowing, particularly when we look at GDP, which is not the best indicator, but it is an indicator adjusted by inflation. We're looking at a flatline growth. And it's not just that we're looking at that data point. The conference board has said that we're expecting slower growth in the United States. The IMF, the World Bank, has looked at slower growth in the United States, in Europe, and throughout the world. So because of that, if we have slower growth and a slowing economy, even with lingering inflation, as we had at the sort of middle to the beginning of the final quarter of last year, the Fed is going to have to take that into account, change its language and say, you know what, inflation may or not still be persisting. It's now 2.5% or even a little bit more than that on average instead of where we wanted under 2, which is somewhat arbitrary anyway, but we have a slowing economy. So therefore, we're going to look at that data, and I think we're going to see more from a mid-year perspective of an acceleration in rate cuts than was talked about the end of last year. And we also are seeing financial problems that were absolutely present last year. I've talked about commercial real estate, bank leverage. Yes. We are seeing the highest levels of delinquencies right now, commercial loans, since even including going into the financial crisis of 2008. So there's still a lot of problem loans that have been attended to by something called extend and pretend, which is something that the New York Fed itself wrote about last year, which basically means that there was a lot of reevaluation of loans, extension of loans, a sort of reassessment of interest rates on loans. And now what's happening is after that period transpired, the same loans are coming up for delinquency again. So basically there's a double down of delinquencies on loans that have already been extended. The pretend is, let's pretend our balance sheet's okay. And then there's more coming in that weren't even extended yet. And so we are looking at financial weakness, which the Fed absolutely has to pay attention to, and which the larger banks will definitely be discussing with the Fed, with the Trump administration, with the Treasury Department. I think there has just been a lot of massaging of numbers on a lot of the books of banks because of these extension of loans, which allow you not to take a loss, and because there are just more problems coming in. And a lot of that's because of what happened in the wake of the Fed rate cuts. We saw a steepening of the yield curve. We saw that mortgage rates and other types of lending rates at the long end actually stayed the same or rose in terms of yields. And so the pain that is felt from the debt perspective that banks have to take into account because they anticipate money to be repaid into loans, and when it's not, because individuals or commercial entities can't pay on their interest payments because they expected them to go down and they didn't, that's going to have a ramification on what the Fed looks at. And also what happens, this is not just in the United States that this is happening. This is a phenomenon that's happening in Europe, that's happening throughout the world, that interest rates, in particular in more borrowing-centric nations, in terms of their consumers and their companies borrowing more, have not been able to really have interest rate relief, or payment relief, even with the Fed having cut rates by 100 basis points last year. So this is something that's going to come into play this year. The Fed's going to have to be very careful. I think the Trump administration is going to be very aware, maybe not of the banking problems per se, but of this issue of debt and delinquencies and their own rising debt and how expensive that is, that there's going to be pressure on a backdoor basis to the Fed. Now, the collusion comes in. The Fed's supposed to be an independent entity. It's dealing with all these other central banks that also are seeing their own problems. There is an impetus to cut rates by more than any of them suggested. There's a follow the Fed kind of thing. So the ECB is looking at the Fed to change its language so we can go back and say, yeah, inflation's still high in Europe and we did our rate cuts, but allow themselves to do more rate cuts this year. Same with the Bank of England, who made the bizarre decision last year to not show how much they were basically supporting the banking industry, being transparent in that manner as they had been in the wake of the financial crisis. So there's a lot of stuff going on behind the scenes and concerns about liquidity in the large financial player districts.